Hi, and welcome to our end of the year update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with the current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to concepts in the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month, we'll be reviewing our safety belt systems. We'll be reviewing the momentum rotation systems and how those systems can dovetail with the safety belt systems to possibly enhancing our investing performance. Then we'll review our free Sector Surfer strategy that comes with any Sector Surfer subscription. Then, since it's the end of the year, we'll review our once-a-year Ray Dalio all-seasons portfolio. Then we'll again remind ourselves of the rules for the stock tip strategy. So let's get started. So when we review our systems, first system that we'll review is the stock market safety belt systems. The one that I reviewed in my book is called the 20-month simple moving average system, the one I call 20-month SMA. Think of safety belts for stock market investing. They don't prevent all losses. However, at least for larger bear market crashes, it would be more difficult for our system to lose as much money as the general population. So the 20-month moving average rule is simple. All you do is take the S&P 500 index fund, get the 20-month moving average. If the fund is above the 20-month moving average, we can stay in the stock fund, otherwise get out. Remember, this is a safety belt that works once a month. We only watch this once a month. Not more than once a month, not less than once a month. If you watch more than once a month, there's a good chance that you may get whipsawed. In other words, one week you're out, next week you're in. By definition, you're buying high, selling low. Or if you forget to watch this for a couple of months, and during that time the stock market starts to crash, we don't catch that crash early enough to make a difference. So here's a graphical representation of what I mean. If you take a look at this graph, the jagged blue line is the S&P 500 Index Mutual Fund. The ticker symbol I'm using here is the Vanguard version, VFINX. And the red line is simply the 20-month moving average of the mutual fund. You can see how when the fund is above this red line, it tends to keep going up for months to years. However, if 1 month it goes below this line, it tends to keep on going down for months to years, like how it did in 2000 and 2007. Now, yes, occasionally you will have some whipsaws, like here in 2012, 2015, 2017, and these whipsaws will result in underperformance compared to the market. However, you'll see that at least with the data that we've had, these small whipsaws are small prices to pay to avoid these bigger losses, where losses of 50% will require 100% gains just to break even. So how do we do this month? At the end of the month, our mutual fund ended at $298.16 per share, and our moving average climbed up to $261.32 per share. So yes, the stock market is still above the moving average. It's relatively safe to stay in the S&P 500 Index Mutual Fund for now. And you don't have to make this calculation. I just do for illustrative purposes. If you take a ratio of the stock price to the moving average price, you get a 14.1% cushion. In other words, next month, as long as the stock goes up, goes sideways, or even loses up to 14.1%, we're still relatively safe. However, if the stock market drops more than 14.1% by the end of next month, it would most likely have crossed into danger territory and we would get out at that time. But we'll cross that when we get there next month. So here's the effects of switching based on the 20-month moving average. You can see how the black line is the results of holding on to the S&P 500 Index Mutual Fund, and when the mutual fund goes below the red line, we sell stock and we buy the long-term treasury bond fund. When stock goes above this red line, then we're back in stock fund, etc. You can see how whenever there's big losses, we tend to mitigate that risk. However, when there are whipsaws, we tend to also decrease our gains. No system is perfect. This is the Achilles heel for this particular system. And just to make things clear, even though this blue line represents the S&P 500 Index mutual fund, and although all data is corrected for dividends, in other words, when the mutual fund distributes a dividend, the dividend is reinvested in the fund. The black line is not only switching between stocks and bonds, but also charged a 1% year fee if you elect to have this professionally managed. So here's StormGuard Armor. For this past month, we've stayed in stocks. That's why the white line and red line are exactly the same. And if we take a look at the StormGuard Armor indicator right now, it's still a smidgen positive. It is getting higher positive. It's now 0.64%. Doesn't matter if it's 0.1 or 1 or 4. As long as StormGuard Armor is positive, it's relatively safe to be in stock market. Otherwise, if it's negative, like how it did 3 times this past year, we were out. So yes, with StormGuard Armor, we did get whipsawed 3 times. Remember back in October, stocks were crashing. We got out of the stock market in November. We were in bonds. That's why for last year, we were actually positive when everyone else was losing around 4 or 5% in the stock market. However, because we were still in bonds, in December, stocks started shooting up and we lost out on much of the January gains. But we got caught ourselves, we got back into stocks, and then in May, when stocks started crashing, we got out of stocks, but then it was positive again, so we got back into stocks, and then again in September, we got out of stocks, we got back into stocks. Let's see what the effects of these whipsaws have done. Here's a 1-year performance of switching between stocks and bonds using StormGuard Armor. You can see how the white line, we were in bonds beginning of January, and as bonds started to crash because stocks were climbing up so high, we were losing money and the gap widened. Now, you've probably noticed that we got back into stocks in mid-month, January 27, not at the end of the month. And that's because last year, StormGuard Armor was upgraded to StormGuard Armor Plus, and I'll explain how to get the Plus later. But suffice to say, at least for now, we got back into stocks in time to catch much of this run-up, but then when stocks started to crash again, back in May, we got out of stocks end of May, but then we got back in to stocks in June when stocks suddenly started to run up again. Now, as stocks started to drift down from end of July, beginning of August, it met criteria again to be dangerous enough to get out of stocks. So yes, we got out of stocks, and of course, as soon as we got out of stocks and into bonds, that's when stocks started to climb up again. So that's when bonds started to crash. But again, with this particular version of StormGuard Armor, we got back into stocks in mid-month. Again, highly unusual. Statistically, if this happens once every 3 years, that's about average, so having 3 in 1 year is extremely rare. But we did end up positive for the year. Not 31% like in stock market, but remember, we're not trying to beat the markets every year. All we're trying to do is protect against the losses. So put this in context in terms of 31 years of back testing. You see how the white S&P 500 Index line compares to our system. The red segments are when we were in the S&P 500 Index mutual fund. The white segments were when we were in the long-term treasury bond fund. Sometimes we're in it for several years. Sometimes we were in it for maybe a couple months or so. Like this year, we were in so briefly, it doesn't even register on this map. But I guess it was just, thank goodness that we started using StormGuard Armor Plus in the beginning of this year when it would have made the biggest difference. And here's how to toggle StormGuard Armor Plus. If you go to the website and you click on the eye next to your strategy, you get this pop-up menu. And with this pop-up, you can go down to StormGuard options. You can either turn off StormGuard, use the old version of StormGuard called StormGuard Standard, use a less old version of StormGuard called StormGuard Acute Quick Response, or use the newer iteration StormGuard Armor. And remember putting the ticker symbol of the fund or strategy you want to use when it's dangerous to be in stocks. Now, to toggle StormGuard Armor Plus, remember that strategy tuning options, click on the forward walk progressive tuning. This is a way where StormGuard enhances its AI to fine-tune the filter. So once you click on StormGuard Armor and click on forward walk progressive tuning, save, and then you get back. Now here's the old version of StormGuard Armor. You can see how we got the same signals to get out of stocks. However, the signal to get back in was, again, each time at the end of the month. In fact, for this one, it was at the end of 3 months. So as a result of being in bonds a little bit too long each time, we actually were negative had we stuck with the original version of StormGuard Armor. Now, this isn't just fudging the data, backtesting. This is actual. We actually use StormGuard Armor Plus. And for my clients, you all know we were positive this year because we were using StormGuard Armor Plus and not StormGuard Armor. Now, just to compare, this is how StormGuard Armor, the old version, used to work over the same 31-year time period. Now, of course, as a data scientist, I'm kind of curious how to compare apples to apples, so I plot my own data. And just to unscramble the spaghetti, the blue line here is the S&P 500 index. The red line here is long-term treasury bond fund. I'm adding in a mutual fund here called the VBINX, the Vanguard Balanced Index Fund. What it is 60% total stock market fund, 40% total bond market fund, automatically rebalanced. Most portfolios that are balanced around 60-40 stocks bonds may perform similarly. So I'd like to use this as a benchmark of what most people do. Green is switching based on 20-month moving average based on my book. The purple is the old version of StormGuard Armor, and the black is a new version of StormGuard Armor. So yes, at least on backtesting, the new version of StormGuard Armor has outperformed the older version of StormGuard Armor fairly consistently. In fact, the differences are so hard to discern on a linear graph that it's a good idea to use a log graph to look at these data points as well. So for those of you who are familiar with how to interpret log graphs are easier to look at absolute percentage changes between graphs. And here we can see that yes, the Balanced Index Fund is a happy medium between the blue and the red lines. The green line outperforms to an extent, but then the StormGuard Armor lines just not only outperforms, but smooths out the ups and downs more consistently. Now again, just to let you know, for the benchmarks, they're all dividend corrected, so are our results lines. And our results are all corrected for a 1% annual fee in case you want to see the net effects if you were to outsource someone else doing this for you. And here's the same data in table form. You can go ahead and pause the video. What I'm showing here is year by year how the S&P 500 Index Mutual Fund, the Balanced Index Fund, switching between stocks and bonds using 20-month moving average, using the old version of StormGuard Armor and the new version of StormGuard Armor Plus. We can see how, especially the red numbers are where I highlighted when there were losses. Now it's true that even with the advanced version of StormGuard Armor, we don't always beat the markets. For instance, here 2009, we only made 7%, whereas the markets made 26%, even the Balanced Index Fund made 20%. And the most important thing is, when you look at times when there were market losses, our losses weren't just mitigated, we actually made money during these crashes, like here 2000, 2002, and here in 2008. This year, we're underperforming the markets. And just for fun, I added a percent time in bond fund. In other words, how long were we actually in the markets and how long were we out of the markets and in the bond fund. So for the 20-month moving average, we were in bonds approximately 16.71% of the time. With stronger armor, we were in 28.85% of the time. And in stronger armor plus, we were in only 23.43% of the time. So we're diversified over time, just not all at the same time. And here are the compound annual growth rates of all these systems. With the balanced index fund, they're getting 8.2%. We're taught that this is supposed to be a good rate of return, and that if you were to put everything to stock, you get a little bit higher return. However, chances of losing more are greater. Why not directly mitigate the risk and let the returns take care of themselves? So the next set of systems we're reviewing is the momentum rotation systems. Now, in my book, I detailed one particular system called the MRI system, the monthly rotation investment system. A couple of years ago, I stated we are no longer following this system. It is not only underperforming sector server strategy, it's also more volatile and more risky. Even when we use the same three sector mutual funds, the S&P 500 Index Mutual Fund, the Emerging Markets Mutual Fund, and the inverse S&P 500 Index Mutual Fund, using sector server's version of rotation, yes, it does better than the version in my book. And it still doesn't do as well as when we combine conventional fund rotation with stronger armor. So I'm no longer following the sector server version of MRI either. Now the whole thing about momentum rotation systems is we're taught that pie chart investing is the way to go. When we get some money, we're supposed to put a little bit into stock market, real estate, international stock market, emerging markets, bonds, tips, with some variation of this. I'm using this particular variation as detailed in Tony Robbins' Money Master of the Game by this money manager called David Swensen. David Swensen is a legend among university endowment investors. He managed the Yale Endowment Fund and has performed 14% per year for many years. And this is the particular portfolio he recommends to his own family. So of course, I like to backtest this. So here's the backtested results. If you take a look at the color of each of these mutual funds, and looking at the spaghetti graph, looking at the white as the S&P 500 index reference, the yellow is what this portfolio is doing. So it's true that the yellow, we're not as volatile. It doesn't go up and down nearly as much as the rest of the stock market. However, here's a quirk of modern portfolios. The individual components are now so well correlated. Look at real estate, international markets, as well as the U.S. markets. They all tend to go down at the same time. So yes, even though the markets lost 43% between 2007 and 2009, this yellow only, and I say only in quotes, only lost 25%, which means I had to make 33% just to break even. And this is if we diligently rebalance every quarter. So here's an example of using those same 6 funds and rotating. Now, how do you rotate with Sector Surfer? Well, what happens is Sector Surfer takes every single one of these lines, and because the author is a signal processing engineer, he has a pretty good idea about how to strip the noise away from the data so they get a better idea of what the momentum is for each of these funds. Once we know which one has the best momentum, we just buy that one fund and stick with it until some other fund does better. So just by doing this, we're trading approximately 5 times per year, and we're getting this graph. Now this multicolored graph represents how much time we were spending in which fund. So for instance, the times we were in the green fund, the emerging markets fund, are in this segment. Times we're in the red fund, the total stock market fund is here and here, etc., etc. So just by rotating, we can not only mitigate risk, especially during the bear markets, but we can more optimize the momentum, and as a result, decrease overall risk. Now, I've just shown you 2 different ways to invest. One is using the safety belt system, and one is to use the rotation system. What if we were to combine the 2 systems? So if you notice, we have 6 funds, 4 of which are stock funds, 12 of which are bond funds. If we were to take the 2 bond funds out and rotate only through the stock funds when it's relatively safe to be in stock market, and then rotate only through the bond funds when it's relatively dangerous to be in stock market, we get this graph. So this graph is smoother. It trades maybe only 4 times a year, not 5 times a year. And as a result, we're improving our performance from 14% to 16% per year. Now again, past results doesn't guarantee future performance, and no, we're not beating market every year. We're only doing 2 things. Number 1, we're trying to avoid the big bear markets. Number 2, we're trying to optimize momentum. That's it. So of course, as a data scientist, I love to compare the systems more on apples to apples comparison. So the white line represents the S&P 500 index. The blue line represents the balanced index fund. The yellow line represents that portfolio minus annual fees. The red line represents just rotation minus annual fees. And the black line is adding StormGuard armor to our strategy. So again, here's the data. Year by year comparison between rebalancing in a pie chart, rotation by itself, rotation plus StormGuard armor, the S&P 500 index as a reference guide, as well as the balanced index fund as a reference guide. Again, look at the years when there are red numbers. These red numbers are the dangerous years, especially if you retire just before them. Rotation and StormGuard armor doesn't avoid all losses, but makes larger losses less likely. And here you can see the compound annualized growth rate for each of their strategies. So the next system we'll review is the free strategy that comes with Sector Surfer. So when you sign up for Sector Surfer, you get a free strategy. It uses generic asset class funds. It uses an older version of StormGuard and goes into cash when it's relatively dangerous to be in the stock market. So here's how one of them looks like. It's called My ETF Asset Class. It uses these particular ETFs. It trades maybe 3 times per year. And if you like the performance of this particular strategy, go ahead and use it. It's free. And this month there was no trade signal. So the next system we'll review is the Ray Dalio portfolio. We only review this once a year because basically it's a pie chart. You just rebalance once a year. The rest of the time you leave it alone. So there's no advantage in watching more than once a year. So here's how the Ray Dalio all-season portfolio works. As detailed in Tony Robbins' Money Master Game book, Ray Dalio realized that there were only 2 economic conditions to worry about, whether or not there's economic growth or falling or inflation growth. And in each of these situations, different asset classes perform differently. So when combining these asset classes into this particular formula, we can cross-mitigate many of these risks. Now you may notice we're only 30% in stocks. We're much more long in long-term treasuries, and in fact the majority of the portfolio is in bonds when you combine the long-term and intermediate-term treasury bonds. Then you have some in gold, some in commodities. So here's what the pie chart looks like, and here's what the graph looks like. Over time, over the last 27 years, if you take a look at dark black line, this is what the portfolio would have done over the last 26 years. It's true it never does as badly or worse than the worst fund. It also never does as well or better than the best fund. However, even though it's doing average, it's so smooth that the chances of losing much in any one year is severely decreased. That's the whole point. So here's a table comparison. Again, I highlight all the losses in red. If you take a look at weighted, which is the performance of the pie chart, every time there's a loss, it's been less than 5%. The most recent was 2018. This year we did gangbusters. Now overall, we're only performing 6.7%, and this is after correcting for a management fee. We're doing slightly better than intermediate term bonds and gold with less risk. So if you're doing the Ray Dalio all seasons portfolio, it's a buy, hold, and don't worry about it for a year type of thing. But again, every year you might want to rebalance. And because of this balancing thing, you need a certain minimum size of account. Otherwise, commissions will eat up. So our next system, we'll review our rules for stock tip strategy. Basically, stock tip strategy, if you really want to buy a certain stock for some strange reason, which I don't recommend, limit the risk to only 1% of your portfolio or trading account. So that means if you're going to use a 25% trailing stop loss order, use 4% of your trading account to buy that one stock. This way, when it loses 25% of this 4%, you only lose 1% of your portfolio. Get it? So, use only 4% of your trading account to buy that one stock, immediately enter a 25% trailing stop loss order, and then just periodically watch it. I would recommend watching at least once a week. And this way, if it goes up by 33%, you can go ahead and use another 4% of your account to buy another block of stock. Because think about it. If it goes up 33%, if it goes 25% down from there, you've basically gone to break even, and your risks of losing is extremely small. So at this point, since it's relatively riskless, you can go ahead and risk some more and buy some more stock. If this stock really is going to the moon like how you think it is, then you'll eventually be following this cycle over and over again until it takes over your portfolio, which is actually a good thing because now you're fully invested in that one stock with relatively lower risk. However, most stocks eventually get stopped out. So keep that in mind. Keep those trailing stop loss orders in place. And again, just keep repeating until you're stopped out. So in summary, this month we have reviewed our safety belt systems. We've looked at the momentum rotation systems and see how momentum rotation system could enhance our safety belt systems. We again looked at the sample-free sector server strategy that comes with every sector server subscription. And then because it's the end of the year, we looked at Ray Dalio's all-season portfolio just to see how it's doing. Then we reviewed our rules for stock tip strategy. So keep those questions coming. I know I talked to several of you personally each month, and realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investing strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup session for you, just you and me, all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, reasons why you're investing to begin with, discuss the investing building blocks that are more specific to your situation, and then determine what has stopped you in the past from getting what you want, and then identify what are the most important steps you need to take now to get to your investing and financial goals. And then we'll complete our consultation with the excitement of knowing exactly what to do next to create that road to a future you really want. Think CME, only topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.